Hey guys, welcome back. So in this video, I'm going to be going over the channel portfolio because as of October 8th, it marked its 1-year anniversary. So I'm going to be going over exactly how the portfolio performed over the last year in the stock market, look at what the overall market did and the S&P 500 did in retrospect, talk about whether or not I'm happy with the results of this portfolio. Do I think that I approached the market in a rational way? Do I think that I was, not letting fear or greed guide me when I was making my investment decisions? And then looking back at it and see like, okay, what was all my reasonings for doing things over the past year? Do I think that those are still going to hold up for the next year? Meaning, do I still think I'm going to be taking this exact approach to the stock market in the next year, in the foreseeable future? And how I'm going to be deploying my money and trading around my money to, yield me the best risk reward in the stock market that I can possibly do with the amount of time I have to dedicate to the stock market. For those of you that are just tuning in for the first time, my name is Dan and this is Millennial Investing. And this portfolio that I'm showing you right here was made just over a year ago when I decided I wanted to shift my investment philosophy because I assumed that the stock market was, kind of red hot. I thought it was going to be trading choppy for quite a while. I thought there were a lot of risks that weren't getting properly priced into the stock market at any point in time. And I decided I needed to hedge my growth investments with some, less volatile companies. And I believed I needed to protect myself and my capital in case things went south, whether from the US and China, whether from Brexit, whether from the Fed. So many possible things could have gone wrong and really put all of my capital at risk. So I decided to take a more balanced approach with mixing growth, value, dividends, and a couple of other investment ideas together in order to create a hedged portfolio that would be able to return me a decent amount of money regardless of what the economy was doing. And so that's kind of what this was about. Before that, I was a pure growth investor, realistically. And I use the term growth investor and trader kind of interchangeably, and not to offend anybody, but this is just a quick little tangent. In my opinion, growth investing and trading go hand in hand because if you are a growth investor, you're constantly waiting for the story to change or get better to move in and out of your position, just like a trader would with any type of catalyst in the news, as opposed to a long-term value investor that essentially wants to park their money in this company and not touch it for a decade at a time. So I'm going to be using the term trading and investing interchangeably here because of that. So just keep that in mind and, let me know in the comment section down below if you guys are not okay with me using those two terms together. I know some people don't care and some people are very passionate about those two definitions. So just let me know in the comment section down below. I do not mean to offend anybody. But without further ado, I'm going to be going into how this portfolio returned, what it did in comparison to the market, and then also what are my plans for the foreseeable future and for the next year. Do I think that this same type of investment strategy is going to yield me the best results? Do I think that this yielded me the best results this past year? And then I'm going to be talking about how I want to change the positions around for the foreseeable future based off of what economic conditions I see right now. So hopefully you guys get some use out of this video. Hopefully it's pretty entertaining. Hopefully this is able to show you guys exactly, what kind of weight does it have to the amount of research I do with the stock market? Is it just kind of all guesswork? Or, is there some, real data behind driving my decisions? And, am I making investment decisions based off of fear and greed? Or is it based off of rationality and, really putting my money where I think it is going to yield the best return based off of fact and not fiction? So hopefully you guys like this, and without further ado, let's get in the video. All right, so starting things off at the top, so the overall portfolio's return was just under 12%. That is included about a 15% cash position. If you exclude the cash, the portfolio's return was just under 14% for the year. And then in retrospect, you can take a look at the stock market average, so the S&P 500. This is tracked by the Vanguard ETF, ticker symbol VOO. Which just mirrors the S&P 500, and I used that as my benchmark. And in the same time frame that my portfolio returned between the 12 and 14%, whether or not you want to include cash, the S&P 500 returned just under 3%. It was a 2.92%. And then the Vanguard Growth Index, so, the more aggressive and volatile type of companies in the S&P 500, those companies returned just over 7% with a 7.01% return. So when you look at either one of those metrics that I think are the fair benchmarks for someone like me to compare themselves to. And, obviously you shouldn't compare yourself directly to these benchmarks, but it's nice to know like if the amount of work that you were putting in was worth it to outperform them. As you can see here, I greatly outperformed the overall stock market, and then I still almost doubled the performance of the growth index. So in my opinion, it was definitely a good year. I think I could have made some better investment decisions that I'll get into in just a bit, but it's not too shabby for just the concentration of making money. And I wasn't going to put my money in a passive index fund because I believed that my active management would be able to outperform the stock market yet again. This was now my 6th year ending in the stock market, which is kind of wild when I think about it. But I do believe that an active manager with a good head on their shoulders and someone that is really able to separate their emotion from the stock market should be able to at least either keep on par with the stock market or outperform it at any given point in time. I do not prescribe to the efficient market thesis. That just never sit well with me. They tried to teach that to me when I was in college, and I just personally do not buy it. So that's a totally different topic for another video, but for right now, this was just kind of my approach, and on a top level point of view, I think I performed pretty well. Now, getting into the positions, so as you guys can see here, kind of going down from the beginning of the portfolio to now, I realistically have only invested or traded around a handful of different companies. And that's because I do not think anybody that is managing money, unless you are a really advanced high-frequency trader, you should not really be jumping in and out of a bunch of companies, say any basket more than, say, a 15 lot size at any one point in time. However, that is not to say that you can't overly diversify and put it into 20, 30, 40 stocks. But personally, for the way that I approach the stock market, I want to know very well a small basket of companies and put my money into them accordingly. And so that way I know and I can keep track of all of the companies, what's going on with them, what are, competitors that are emerging, what are possible catalysts to the upside or to the downside of any of these companies at any one point in time. And I don't require, 80 hours of work a week in order to keep track of them all. So when I want to have this level of an active hand in my investments, I think that I just can't handle more than, say, 15 to 20 companies at any one point in time. I would prefer to keep it between 10 and 15, but definitely 20 would be my hard limit. And that's just because I don't have the amount of time needed to actively manage all of those different companies to the extent that I think I need to know any company that I'm putting my money into. Now, if you're a long-term investor, that doesn't really matter to you. You can take months and months and months when researching a company, realize that, okay, I'm going to be in this company for the long term, park your money into it, and then you might only check up on the company once a year, maybe. And, if you're taking that approach to it, that is extremely valid. It has worked out very well for a lot of people in the past, but I am not personally one of those people. So, so as you see here from all the different positions that I've made, they all kind of float around the same types of companies. You guys know that I am a extreme bull in the semiconductor space. So most of my companies actually relate in some way or form to either data, semiconductors, or information technology. And that just kind of stems from the fact that I have worked in IT for over 6 years. I have a degree in information systems. Tech companies are just kind of my niche. Tech companies and most recently fast food and restaurant companies have been kind of where I focus in. Those are the industries I feel most competent in. And that's where I think that I know whether or not when I put my money into it, whether or not I'm getting a good deal or not. So as you can kind of see my track record, I've gone in and out of NVIDIA, Altria, British American Tobacco, American Eagle, Nintendo, Skyworks Solutions, Pepsi, IAU, which is just the ETF to manage gold, and that was just due to a macro bet that I made a year ago, which thankfully paid off for. I should have put more money into that looking back on it. Micron, Intel, Starbucks, AMD, Facebook, National Beverage Corporation, Monster Beverage Corporation, Starbucks again, Tesla, Apple, Google, AbbVie, Domino's, and that's about it for the types of companies that I really look into. So those companies are obviously not the only ones that I've looked into, but they were the only ones that I looked into, had attractive valuations, and that I thought I understood well enough to be able to manipulate my money in them to get a good return on my money. And so throughout the year, you can kind of see, generally I go through like tranches, whether or not my trades are working for me or working against me. And so that's something looking back on it, I never really noticed before, but it's something I definitely need to keep in mind on when I deploy my money. A lot of the times, apparently, I'm deploying my money just because I'm getting bored and antsy and I need to deploy it. And then other times, I'm deploying it because there's a screaming buy out there. And so I guess looking forward, I really need to focus in on figuring out what made, this section of all of my acquisitions be, at proper valuations that go up in value versus these ones that kind of, I put my money into them and they just sank like a rock. Now, obviously, no one's going to be able to know for sure what the stock does in a short run after they buy it, but that's a pretty clear pattern to me that generally, depending on when I'm making my acquisitions, that depending on the month that I'm buying them in, let's say, I either do really well or really poorly with those positions over the rest of the year. So I thought that was kind of funny. Now, looking at all this, and kind of, it was very clear of what companies I was able to trade more successfully than others. Trading successfully meaning that they were making me money within one calendar year. And I kind of want to get into that right now. And that's kind of breaking down the two different philosophies I had incorporated in this portfolio. Almost every investment in this portfolio can be broken down into a stock that I was trading at a really bargain discount valuation. And that was my attempts to go into a company with a discounted cash flow approach, look at what is the intrinsic value of this company based off its fundamentals, and then where that industry is going, what the market's pricing into it. And then I thought that this company was just dirt cheap compared to what it was actually worth. And then for the growth trading, going back to what I said earlier, these were companies that I thought that due to catalysts and me kind of really understanding what is going to make the stock move up or down in, say, 1 to 4 month time frames, I understand that, okay, this is going to unleash a lot of value or has the ability to unleash a lot of value into the company, and it's trading at a decent valuation right now. I think I'll add in a position here and then see how, I want to update that position as more information becomes readily available. So those are the two types of investment philosophies that I had with this portfolio. And there was a clear winner. So with my value stocks, almost all of them are down a pretty significant portion. The average one is down almost 20%. And so like if you look at all of the amount of money that I took from this portfolio and I put it into, say, these valuation stocks, my average return was a negative 12.25%. So that is obviously not stellar. Obviously, if you're a deep discount value investor, you are not expecting to get your massive returns in one calendar year. However, I definitely was not picking at any bottom throughout this year when I attempted to pick a valuation-based stock. On the other side, with my growth trading and, say my extremely active position trading, I was able to actually manage fairly well. I almost beat my yearly average over the past 5 years. And so every position that I made with this type of philosophy in mind, I averaged just under 20% with a 19.89% return on pretty much every position I took. So looking at that number, it is pretty obvious that I am a much better growth investor or trader than I am a valuation picker. Whether or not that is going to be the case for the foreseeable future, say over the next 5 years, who knows? A lot of the companies that I bought into this past year were companies that I thought just had extremely unlocked value or extremely discounted value that just wasn't justifiable, that I was expecting, over the next 5 years to just explode with the return, whether it was mixing a company like Altria, and you have an 8% dividend yield with roughly a 40% discount to its intrinsic value. You couple those together and you wait about 5 years and it catches up. That's a massive return on an investment. So who knows what will happen with my, valuation picks versus my trading picks. But I do think that for this year, and something that'll give you guys a lot more of a benefit at home watching, my portfolios and how I would manage money. Again, definitely not as an investment advice, but just also like kind of testing out different investment theses. And, you take one thesis, you do your homework, apply it to what you personally know and your personal investing style, and then see what the returns are. I think I'm going to split my two main core philosophies into two different portfolios. I'm going to take my portfolio here and split it right down the middle and either create two $50,000 portfolios that I'll just kind of trade off of, and we can see, check it in periodically to see how those are each doing, or make them both, say, $100,000 portfolios and just track them year over year and see how they perform, and how much work was required for maintenance, be it the valuation one or the trading one. Because I can tell you right now, just on a broad spectrum, the trading account definitely takes about, say, 6 times the amount of time and effort required than the valuation one. Because with the valuation one, I'm able to do my homework, put my money in, and then just buy it as the stock gets cheaper. With growth trading, I need to put my money into it and then monitor that company on a daily basis. So that requires a lot more time and effort. But, as of this past year, being able to get a 20% return or a negative 12% return, obviously the extra amount of homework was way worth it. So we'll be interested to see, in the next year, is that type of philosophy still carrying over, and that my trading is significantly better than my investing. And that's something I want you guys to let me know in the comment section down below. Do you want me to split these two philosophies down? Because the more and more I thought about it, and the more and more I thought about someone that wasn't me looking at this portfolio, they'll probably be very confused with why I have companies like Google, Nvidia, and Tesla in the same portfolio as I have BTI, AbbVie, and American Eagle. I imagine that if you're looking and you're interested in any of those companies, you're not interested in the other ones because, not many people are combining the two ends of this investing spectrum together into one portfolio. So let me know if you guys think that I should split them up, so that way you guys can only watch the videos that you think are useful to you. So if you're a long-term growth and dividend investor, you're only going to want to see my portfolio with those types of companies. And on the flip side, if you're a growth investor or if you're a trader, you only want to see the companies that I'm going in and out of that, say, are going up, their earnings are going up at a 20% clip, or, I'm actively trading in and out of them for the ability to get a much higher return in a much shorter time frame. So let me know if that's something that would be interesting to you guys. Let me know if it would bring any value and any other way that I can kind of tweak this portfolio, so that way you guys can really get a real-time view of what's going on with me. I do plan on taking these sheets, and then once I really figure out what I'm going to be doing for this year, I do plan on making links that I'm going to be able to give to you guys, so you guys can see and check in on a daily basis just to see, okay, what's going on with the portfolio, what did Dan do? Just so that way you guys can see if there's a massive move in the market. You guys can see if I don't put out a video on it, you guys can just check the account right there and just see, like, okay, what did Dan do? This definitely, again, isn't for financial advice, but you guys can at least follow along with me and kind of see how my philosophy and my thought process works in the overall market. So that's it for this video. It's getting kind of long. Hopefully I can cut some of this out so you guys aren't stuck here for about 20 minutes. But hopefully you guys got some use out of this video. Let me know in the comment section down below, and I will catch you guys in the next one. Peace.